Okay, so in summary, we have talked about quite a few strategies that's related to stocks and how to use options to help the stocks. So covered call is a very popular, very easy to do and comfortable trade, but it has very bad returns. This is because it gives up the upside profit because of the covered call. And it doesn't have downside protection. If the stock drops by a lot, your portfolio also drops. So in my opinion, the covered call is one of the worst trading strategies. You don't get much upside, you get all the downside. So I highly recommend not do it. And collar means you sell covered call, and then you also buy put to protect your downside. So this is a more balanced strategy. And I think it's much better than the covered. You give up some upside potential, but you also reduce the downside risk. You reduce the overall volatility of your portfolio significantly. So this could be a useful strategy if you need the money in the medium term, but you don't want to put it in the bank. You want to risk it so that if the market grows, you also get some of the gain. Then collar could be a useful strategy. And if you think that collar is too much trouble, you can consider buffered ETF because they are often implemented using collar or some variation of collar or some combination of collar and covered call. But for some buffered ETF, it only has limited downside protection. So you are taking more risks. If the market drops more than that, you are continually exposed to the downside risk. So that may not serve your need that you need the money in the medium term. So you need to be really careful if you want the other style of the buffered ETF where there is limited downside protection. And there's a married put where you buy put to protect the downside, but you don't limit the upside. So married put is very painful because you lose money on puts most of the time, and you only make money on them when the market drops. And tail hedge is another extreme form of married put where it buy a lot of put, very far out money put. And every month you lose a lot of money on those puts. They are too far out of money. So this is a very painful strategy for me. And I don't know about you, but if you don't like to lose money most of the time, don't do it. But my back test shows that if you can do it, you might have good payoff when the market crashes. But there's also a possibility that you cannot stay that long. Maybe the market has a long run of the bull market, but you keep losing money on put and you stop doing it before the market crashes. So tail hedge is the most painful strategy, although backtest shows that it can beat buy and hold. Covered call is a very comfortable strategy. You take money most of the time because you can sell the call and the call can expire. But covered call is not a good strategy. Tail hedge is too painful, and if you cannot do it, it's not a good strategy for you. Collar has limited use, depends on your use case. Okay, that's all for today. See you next time. Thanks.